Michael Burry explains why the 2022 US housing bubble will not pop.
There were probably junior analysts that were given the task of reviewing these documents.
It's practically impossible to turn on the news without reading headlines describing the imminent collapse in house prices. Some say it will happen in 2023, others in 2026, but few doubt that the era of pandemic house price rallies is over. In a tweet published last month by Michael Burry, which, believe it or not, the Big Short investor deleted, he explained how the Federal Reserve had increased its holdings of mortgage-backed securities since the onset of the pandemic. Quite a rally given quantitative tightening, right? No, the Fed has not yet reduced its mortgage-backed securities holdings, which have increased since the start of the quarter beginning the 1st of June. Higher rates inhibit refinancing, so that's not happening. They knew this, right? The sheer size of these holdings can be seen by looking at the red area in this chart. Burry is absolutely correct. It has gone up since May 2020 by around $1 trillion, not down. Burry isn't the only one who has noticed this. According to an article in livemint.com, distortions to the US housing market caused by the Federal Reserve could last for years. With interest rates hovering around 5%, existing home sales are down more than 14% from last year, declining almost 6% in July, with mortgage demand 18% lower in the last week of July 2022 than during the same week in 2021. At the higher end of real estate sales, a small uptick in rates leads to a giant increase in overall interest payments during the term of the loan.
If you bought a $500,000 house, let's just say your loan is $500,000 and you bought it 2 years ago and you got a nice 3% rate, your payment would be roughly $2,108. Now, if you buy a house, which roughly today the rate's around 6%, the same $500,000 loan at 6% is $2,997. That's nearly $900 higher. Now, if you were to buy the same $500,000 loan at 9%, watch what happens here. The payment becomes $4,023. It doubles in payment from 3%. Same loan amount, same house, everything's the same. One was 3%, it was $2,100 a month. The other one is 9%, it's $4,000 a month. How many Americans can go from $2,100 a month to $4,000 a month? Not many.
Some potential buyers are sitting on the sidelines until rates or prices drop, while sellers are hoping that the market picks up again so that they can sell for a higher price, or at the very least, stop having to slash prices still further. Some pundits, however, are even referring to the collapse of US home sales as a free-fall phenomenon. The homes whose sale numbers dropped the most were priced under $250,000, as rising mortgage interest rates and energy bills pushed monthly home payments to levels unaffordable for many low earners on fixed incomes. Why does the Federal Reserve even own mortgage-backed securities in the first place? The reason the Fed owns mortgage-backed securities goes back to the financial crisis of 2008, when the Fed was trying to prevent the mortgage market from collapsing. During the crisis, every financial institution in the world had some exposure to the US housing system. Those institutions had no interest in buying more housing bonds in that environment, and without a supply of capital, the Fed stepped in as a buyer, in effect, of last resort. It ended up buying $1 trillion worth of mortgage bonds, in the process pumping that much money into the economy, and it kept buying them for several years until 2015, as the chart reveals. During 2010, the Federal Reserve made a temporary decision to cut back on its purchase of these bonds. This was 12 years ago. Interestingly, this led to reports at that time describing how the housing crisis would worsen as a result, and inflation would increase. In 2022, it's unlikely that from where we are right now with interest rates, that mortgage rates will fall to the levels seen during the pandemic. They only dropped so low in the first place thanks to extraordinary market manipulation carried out by the Federal Reserve. House prices, measured by the Case-Shiller Index, increased 30% between March 2020 and December 2021, which was a steeper rise than took place in the lead up to the housing bubble of 2008. The two main reasons behind this were, one, many people moved during the pandemic, and two, the 30-year mortgage rate was 2.65% in spring 2021, so if you took out a mortgage earlier than this when rates were higher, it made sense to refinance. In the spring of 2020, with everybody ordered to stay at home,
you must stay at home.
The new rules will go into effect Friday at midnight.
Trouble was afoot if jobless or workless households suddenly were left unable to pay their mortgages, both during lockdown and after restrictions were lifted. So the Federal Reserve, in its desperation to avoid an economic collapse, reached immediately for the 2008 playbook. It cut rates to zero and brought back quantitative easing, printing unimaginable volumes of currency and buying long-term government bonds and mortgage-backed securities.
This is your basic mortgage bond. Now, obviously, if you're buying these, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these B's and double B's went from a little risky to dog shit. Where's the trash?
Behind you.
I'm talking rock bottom FICO scores. No income verification. Adjustable rates, dog shit. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to zero too.
You're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
No one is paying attention because the banks are too busy getting paid obscene fees to sell these bonds. Let me put it this way. I'm standing in front of a burning house, and I'm offering you fire insurance on it.
How can these underlying bonds be as bad as you say? It wouldn't be legal.
Nobody knows what's in them. Nobody knows what's in the bonds. I've seen some that are 65% AAA rated, that I know for a fact are filled with 95% subprime shit with FICOs below 550.
Get the fuck out of here.
You want me to really blow your mind? When the market deems a bond too risky to buy, what do you think we do with it? Take a guess.
I don't know, you tell me.
All right. You think we just warehouse it on the books? No. We just repackage it with a bunch of other shit that didn't sell and put it into a CDO. Institutions treat these CDOs like they're as solid as treasury bonds, and they're going to zero.
No, it can't be right. There were $500 billion in housing bonds sold last year alone. The ratings agencies, the banks, the fucking government. You're saying they're all asleep at the wheel?
Yeah. My whole department's long on this stuff. They call me Chicken Little. They call me Bubble Boy. A's, zero. B's, zero. Double B's, zero. Triple B's, zero. And then that happens.
What is that?
That's America's housing market. Thank you.
Most residential mortgages are securitized by Fannie Mae or Freddie Mac in the USA and resold in something called an agency MBS. In 2020, this mortgage-backed security market was in trouble, and the Fed was even more aggressive than it was in 2008. By becoming the only buyer of these securities, its holdings of agency MBS increased by $1.3 trillion between 2020 and 2022, as we've shown in the chart. The Fed now holds more than 40% of the total outstanding amount of agency MBS, or nearly half the market. These actions were one big reason why rates were able to fall so low. US mortgage rates are based on the 10-year bond rate plus a premium for extra risk. That risk premium is determined largely in the MBS market based on the liquidity and rate risk that investors take on, meaning that it can fluctuate over time. The spread spiked at the start of the pandemic, possibly due to risks such as unemployment and job losses, but then as the Fed kept on buying mortgage-backed securities, it fell to almost zero and the housing market exploded. The spread then started to rise again in June 2021 near the end of quantitative easing, and it rose again when the Fed slowed down its purchases in autumn 2021 before stopping those purchases entirely in early 2022. The spread is now higher than it was before the pandemic. Buying mortgage-backed securities may have made sense to the Federal Reserve in spring 2020, but why they didn't start tapering for 18 months, even as the housing market already was clearly overheating, was never explained then and remains unexplained now. Whether quantitative easing actually helps the American economy remains a divisive topic among economists. Federal Reserve economists insist that it does help. But what else are they going to say? Would they ever admit the truth if it achieved nothing? Of course not. No, the central banks are now trapped, and they know that stopping quantitative easing is tricky. because they are the only ones who are buying government debt, since there's a collapse in demand for sovereign debt worldwide. The main reason for that, of course, is that governments never pay anything back. They simply borrow endlessly until everything collapses. The whole model has folded in on itself, and this is something that the news media and central banks seldom say publicly. But back to our topic of discussion. Data suggests that when the Fed buys mortgage-backed securities, it brings down the MBS spreads and the mortgage rate. So when it sells, the opposite should happen. MBS spreads and the mortgage rate should rise together. And this is what brings us back to Michael Burry's comment. The problem with higher rates is that fewer people will refinance or move, so the gargantuan Fed-owned MBS portfolio won't shrink back down as fast as the Federal Reserve might anticipate, even as it contemplates further rounds of interest rate rises between now and the end of 2022. According to a May 2022 press release, the Fed will start selling some of its mortgage-backed securities. If that is the case, Charles Schwab expects that the MBS spread will grow bigger, and the odds are so will the mortgage rates of average American citizens who haven't already locked in a fixed rate term. So between rising rates and a slowing housing market, fewer people will be able to afford to move. As a result, the housing market may still be a lot slower and a lot less liquid for a very long time. It is possible that Burry is calling the Federal Reserve out here with this tweet on its failure to stick to its own plans. Between 2009 and 2014, mostly the Federal Reserve was adding holdings to its balance sheet, both treasuries and mortgage-backed securities. In 2017, the Fed started letting some of its mortgage bonds expire, but in 2020 the pandemic happened, and that was when the Federal Reserve went back again to buying mortgage bonds. The goal, once again, was to put cash back into the economy. It was apparently to make sure that borrowers were able to borrow and that property valuations would still be stable, and it was essentially to help avoid a great financial crisis. And now the Federal Reserve is back to letting its existing mortgage bonds expire so that it gradually owns fewer and fewer of those bonds. And if the Federal Reserve isn't buying more of these mortgage bonds, then a private sector actor would need to step in order to maintain all of the mortgages out there. According to Megan Green, that is, she is chief economist at the Kroll Institute. When private investors buy those mortgage bonds, that pulls cash out of the overall economy. Then there's less capital generally sloshing around in the system. That should slow demand down and reduce house prices. That in theory should take some of the upward pressures off inflation. What this should mean is that inflation should slow down, but in the process there will be fewer house sales, fewer house purchases, and that would tend to align with Robert Shiller's prediction based on data from the Chicago Mercantile Exchange real estate futures market that housing values will decline by around 10% by 2024 to 2025. And we already see that happening. But in the meantime, the Federal Reserve is doing little to rid itself of its MBS portfolio. So much like previous tweets in which Burry has called the Federal Reserve corrupt, useless, and incompetent, he appears to be pointing out the less than salient nature of some of their policy choices. The problem, however, is that the Federal Reserve cannot stop the government from spending money. It can't rein in government spending or borrowing, and even if the government printed its own currency without restraints on spending, problems of this nature will always be likely to make an appearance.